Everyone's talking about how the Bank of Japan's interest rate hike will kill the Nikkei tech rally. But here's the number nobody is mentioning. Japan is now spending more on semiconductor subsidies per capita than the US and the EU combined, all while keeping rates at a 30-year low.
Wait, really? More than the US? That's a massive claim, Alex. And welcome back to Asia Tech Macro. I'm Maya, looking at the world through the lens of a founder. And with me is Alex, who spent a decade at a hedge fund and still refuses to believe any government-backed project until he sees the quarterly free cash flow.
Guilty as charged. But look at the data that hit the wires yesterday, January 23rd. The Bank of Japan held the line at 0.75%. While the carry trade crowd is breathing a sigh of relief, the real story is in the Ministry of Economy, Trade and Industry's budget for fiscal 2026. They just locked in a record 1.23 trillion yen specifically for chips and AI. That's about $8 billion of base funding, not just one-off emergency packages.
1.23 trillion yen. I was reading this morning that within that pot, they've earmarked another 150 billion for Rapidus, Japan's state-backed 2-nanometer dream. It feels like Tokyo is finally graduating from planning to building. But Alex, let's be real, Rapidus still has 0 confirmed customers, and they're supposed to start mass production in late 2027. Isn't this just a very expensive piece of industrial nostalgia?
That reminds me of what happened in 2022 when everyone said TSMC would never leave Taiwan. Now, the Kumamoto fab is the global gold standard for efficient expansion. But here's what most people miss. Japan isn't just buying fabs. They are buying the safety premium. In a 2026 world where the geopolitical risk in the Taiwan Strait is at a constant simmer, being the Switzerland of semiconductors is worth every trillion yen.
Okay, but devil's advocate here. Doesn't a 0.75% rate, even if it's a freeze, start to hurt the domestic Japanese startups who are trying to compete with Silicon Valley's capital? I saw that long-term bond yields are rising regardless of what Governor Ueda says.
That's the friction, Maya. Higher yields mean the zombie companies in Japan finally die, making room for the winners. But for tech investors, the key is the capex arbitrage. If you can borrow in yen at 0.75% and build a fab that services a global AI market growing at 30% a year, the math is unbeatable.
Speaking of unbeatable math, we have to talk about the earnings estimates from Seoul. Samsung Electronics just reported a profit jump that looks like a typo, triple what it was last year.
20 trillion won in operating profit for Q4. It's a recovery for the ages. But if you dig into the numbers from the Samsung Device Solutions division, the story isn't about foundry supremacy. It's about the memory bounce back.
Right. I saw a note from Kim Sun-woo over at Merit Securities. He pointed out that while memory prices are skyrocketing, the yield on Samsung's HBM3E is still the elephant in the room. They're making money because the market is tight, not because they've solved the yield war.
Exactly. And that leads us to our first listener question of the day. If you're a long-term investor, do you buy the Samsung recovery story? Or do you stick with the yield leader, SK Hynix, which is reportedly hitting 80% on HBM3E?
Speaking of the yield war, we have to look across the border at what's happening in Shenzhen and Beijing. I was just reading this morning that NVIDIA's market share in China for high-end AI accelerators is projected to drop below 10% by the end of this year. 10%, Alex. That was an 80% market 2 years ago.
It's a collapse, plain and simple. But here's what most people miss. The demand hasn't vanished. It's just gone underground. I saw a report from Charlie Chan over at Morgan Stanley last Tuesday. He noted that while official H200 shipments to China had stalled due to the new access surcharges and export controls, the secondary market in Southeast Asia is exploding.
You're talking about the ghost supply chain again. I've seen the photos of H100s and H200s being sold in electronics malls in Kuala Lumpur and Ho Chi Minh City. But is that enough to power a real sovereign AI for China?
It's not about the gray market anymore, Maya. That's for the small players. The big players, ByteDance, Alibaba, Baidu, they've pivoted. Huawei's Ascend 900C is reportedly hitting mass production this month. I saw an internal supply chain leak that suggests they've secured enough 7-nanometer capacity at SMIC to ship over 500,000 units this year.
Wait, really? 500,000 units of the 910C? That would make them a legitimate Tier 1 competitor to NVIDIA's downgraded China spec chips. But okay, devil's advocate here. Huawei is still wrestling with the same yield issues as Samsung, aren't they? SMIC's DUV multi-patterning is incredibly expensive and low yield compared to ASML's EUV.
It's a brute force approach. Beijing is effectively subsidizing the waste. They don't care if the yield is 30%, as long as the 30% that works can train their LLMs. That reminds me of what happened in the Soviet aerospace era. Inefficient as hell, but they still got to space first. But here is the question for our listeners. Does the US access surcharge actually hurt China,
Or is it just the world's most effective marketing campaign for Huawei?
That's a cynical way to put it, but probably accurate. But let's shift south. If China is the Goliath under pressure, Southeast Asia is the David that suddenly found a giant bag of gold. I was looking at the FDI data from Malaysia last week. Their data center capacity is on track to triple by 2028. Triple, Alex.
Johor is the new frontier. But I was just reading a note from a grid analyst this morning. You can't just drop a 500 megawatt data center into a grid designed for palm oil refineries and shopping malls. The friction between AI dreams and analog infrastructure is getting messy.
Well, that's why the Vietnam news on January 19th was so significant. They just passed a decree allowing direct power purchase agreements. It basically lets tech giants like Microsoft or Google buy renewable energy directly from private wind and solar farms, bypassing the state grid's bottlenecks.
That is a total game changer for the green AI narrative. It's the only way to satisfy the ESG requirements of the Silicon Valley giants while operating in a region that still loves its coal. But Maya, let's talk about the other giant in the room, India.
Yes, the 24% iPhone story. Counterpoint Research released their latest update 3 days ago, confirming that nearly 1 in every 4 iPhones is now made in India. Tata's expansion in Gujarat is massive. They're not just assembling, they're moving into the component ecosystem.
Okay, but let's rephrase that. They are trying to move into the ecosystem. I saw a note from Sanjeev Prasad at Kotak yesterday. He was quite blunt. India is still a screwdriver economy for now. They import 80% of the high-value components from, you guessed it, China.
That reminds me of what people said about China in the early 2000s. Everyone called them a screwdriver economy too, and look at them now. India's digital public infrastructure, the India Stack, is miles ahead of anything in the West or ASEAN. They're leapfrogging the analog phase.
Digital Stack is great, Maya, but you can't ship digital stacks through a congested port in Chennai. The logistics cost as a percentage of GDP in India is still nearly double that of Vietnam. If you're a margin-sensitive hardware founder, do you take the India hype or the Vietnam efficiency?
I'd take both, but for different reasons. Vietnam is my factory, India is my future market. But here's a question for you, Alex, the professional skeptic. If you had to pick one ASEAN or South Asian currency to hedge against the US dollar volatility in 2026, which one are you looking at?
That leads us perfectly into our contrarian corner. Maya, what is the mainstream narrative that's currently driving you crazy?
It has to be the Japan gold rush narrative. Every major outlet, from the FT to the Journal, is painting this picture of a rising sun, led by a sudden explosion of local Japanese innovation and a return to the 1980s glory days. They're making it sound like Sony and Panasonic just woke up and became AI giants overnight.
And you think it's not that simple?
Not at all. It's a safety premium play, Alex. Let's rephrase that. It's a Switzerland of Asia trade. I was looking at a flow of funds report from Goldman Sachs that came out on Wednesday. The vast majority of the Buy Japan orders aren't betting on a specific Japanese breakthrough in LLMs or robotics. They are buying the fact that Japan is the only place in Asia-Pacific where you can park $10 billion and know for a fact that the rules of the game won't change while you're asleep.
You're hitting on something very cold and very true. It's a boring is sexy trade. Investors are fleeing the volatility of the Shanghai and Shenzhen markets, and Japan is the highest quality safe harbor available. But here is the contrarian kicker. The moment China's regulatory environment stabilizes, even slightly, that safety capital is going to flee Japan and head back to the 3x higher returns in the mainland. The Japan rally is a bet on continued instability elsewhere, not on Japan's own brilliance.
That is a brutal take, but I can't argue with the data. If you're in Japan for the innovation, you might be disappointed. If you're there for the safety, you're in the right place, for now.
Precisely. Risk is always relative. And speaking of risk, we need to talk about the Bank of Japan's next move. Everyone is celebrating the 0.75% freeze, but I was reading a note from an analyst at Nomura this morning who warned that the February forecast might be the real black swan. If they hint at a 1.25% terminal rate for 2026, the entire carry trade that has fueled the Nikkei tech rally could unwind in 48 hours.
Wait, 1.25%? That would be a seismic shift for the Japanese market. We'd see a massive repatriation of capital. That reminds me of what happened in 2007 when the carry trade unwound. It wasn't pretty for the global tech sector.
Exactly. You have to stay ahead of the flow, not the news. Okay, Maya, before our listeners start panicking about their portfolios, let's give them something they can actually use. Action items for the final week of January 2026.
Action item 1. Look at the energy arbitrage in ASEAN. If you're betting on the AI boom, don't just look at the chip designers. Look at the companies that have already secured direct power purchase agreements in Vietnam and Malaysia. In a world of 500 megawatt data centers, the person who controls the green electrons is the one who controls the margins.
Action item 2. Diversify your India exposure. If you're only in the big Nifty 50 tech names, you're just buying the hype. Look at the specialized logistics and last-mile infrastructure providers in Gujarat and Tamil Nadu. They are the ones who will profit whether it's Apple, Samsung, or a domestic Indian brand that wins the manufacturing war.
And action item 3, hedge for the BOJ February forecast. If you're heavy on Japanese tech exporters, look at some protection on the USD-JPY. A sudden shift to a 1.25% narrative will catch a lot of people flat-footed.
Data is the only hedge against volatility, Maya. I think we've given them enough data to chew on for at least 7 days.
I think so too. Next week, we're going to be diving into the deep-sea mining race in the South Pacific. We'll be talking about why certain tech giants are suddenly very interested in the bottom of the ocean to secure their 2030 mineral supplies.
It's a race to the bottom, literally and figuratively. I can't wait to be cynical about it.
I'll try to keep it optimistic as usual. Thanks for listening to Asia Tech Macro. Make sure to hit that subscribe button, check our show notes for the analyst citations, and we'll see you next week.
Stay data-driven. See you next week.
Bye for now.
Goodbye.